Hey everyone, I need to share something with you that most people in silver are completely missing right now. And honestly, even some experienced traders aren't connecting the dots on this one. COMEX just blinked. And when I say blinked, I mean something happened in the data that signals a serious problem brewing beneath the surface. A problem that could trigger a squeeze in February that catches the entire market off guard. I'm going to show you the numbers. I'm going to explain why 87% of silver contracts are mathematically unable to deliver physical metal. And I'm going to break down what that means for anyone holding silver or thinking about entering a position. This isn't speculation. This is contract data. This is warehouse inventory. This is math. Let's get into it. Before I explain the data, let me remind you what this channel is about. We don't do hype. We don't do conspiracy theories without evidence. We track real data from real sources. COMEX reports, warehouse inventories, commitment of traders data, delivery notices. When something unusual shows up in that data, we break it down in plain English so you can understand it, not so you panic, not so you gamble. So you're informed. If you're new here, welcome. You found a channel that respects your intelligence. If you've been with me for a while, you know how we operate. Let's look at what COMEX just revealed. So here's what's happening. Let me start with the basics so everyone can follow along. COMEX is the primary futures exchange for silver in the United States. When people trade paper silver, they're mostly trading COMEX futures contracts. Each contract represents 5,000 ounces of silver, and in theory, at the end of a contract period, the holder can demand physical delivery of that silver, in theory. In reality, most contracts are settled in cash. Traders roll their positions to the next month or close them out before delivery. Very few people actually stand for delivery, and for years, that system worked because there was always enough physical silver in COMEX warehouses to cover the small percentage who wanted real metal. But here's what's changed. The February delivery month is approaching. And when we look at the current open interest, the number of contracts still open, and compare it to the registered silver inventory in COMEX warehouses, the numbers don't add up. Let me give you the specifics. As of the latest data, there are approximately 30,000 contracts still open for the February delivery period. Each contract is 5,000 ounces. That's 150 million ounces of silver that could theoretically be demanded for delivery. Now, how much registered silver is actually sitting in COMEX warehouses available for delivery? Approximately 30 million ounces. Do the math. 150 million ounces of potential demand. 30 million ounces of available supply. That means only 20% of contracts can be physically satisfied, which means 80% cannot. And when you factor in that some of that registered silver is already spoken for through previous delivery commitments, the real number climbs closer to 87% of contracts that cannot be delivered. That's not my opinion. That's warehouse data versus open interest. That's the math. Now, some of you might be thinking, okay, but this happens every month, right? Most people don't actually want delivery. They just roll their contracts. And you're partially correct. Under normal conditions, the vast majority of traders do roll or close. The system depends on that behavior. It's designed around the assumption that almost nobody will actually demand physical metal. But here's why this time feels different. Number one, registered inventory has been declining for months. Or a year ago, COMEX had significantly more registered silver. That number has been steadily dropping. Someone is taking metal out of the system, and they're not putting it back. Number two, large traders are standing for delivery at higher rates. In recent months, we've seen an uptick in delivery notices. More contracts are being settled in physical metal rather than cash. That's unusual, and it's draining the available supply. Number three, industrial demand is surging. Silver isn't just a precious metal. It's an industrial metal. Solar panels, electronics, EVs, medical devices. All of these sectors are consuming silver at record rates. That industrial demand competes with investment demand for the same finite supply. Number four, mining supply isn't keeping up. Silver production has been relatively flat while demand has been growing. That structural deficit means there's less new metal entering the system to replenish what's being withdrawn. Number five, trust in the paper market is eroding. More investors are asking the question, if I own a futures contract, can I actually get silver if I want it? That doubt, once it spreads, changes behavior. People who might have rolled their contracts start standing for delivery instead. And that creates a self-reinforcing squeeze. So yes, most months the system works because people behave predictably. But what happens when they don't? Let me explain what a delivery squeeze looks like, because this is what the February setup is pointing toward. Here's the scenario. Let's say even a small percentage of contract holders decide to stand for delivery instead of rolling. Normally, maybe 5% stand for delivery. But what if that number doubles to 10% or triples to 15%? Suddenly, COMEX doesn't have enough registered silver to satisfy all the delivery demands. Hey everyone, I need to share something with you that most people in silver are completely missing right now. Accept cash and honestly, even some experienced traders aren't connecting the dots price and the physical reality have diverged. Blinked. It undermines confidence. I mean, something happened in the data that signals a serious problem silver from elsewhere at whatever price necessary. A problem that could trigger a squeeze buying in the open market catches the entire market off guard and confirms that I'm going to show you the numbers. Option 3, explain why fails to deliver. Of silver contracts. This is the nightmare scenario. Mathematically unable if COMEX cannot deliver metal to contract holders who legally demanded it, the entire credibility of the futures market comes into question. None of these options isn't speculation. This is contract data. Potentially bullish warehouse inventories. This is math. And here's the key insight. Let's get into it. The squeeze doesn't require everyone to demand you what this channel is about. It only requires enough people to demand delivery that conspiracy theories without evidence. We track given the real data ratio of contracts to available metal reports, that threshold is lower than most people realize. Delivery is why I say COMEX. Something unusual shows up in the data is showing a vulnerability that plain English this exposed a year ago. Not so you panic. February is when it gets tested. Now let me show you how we're actually tracking. If you're new here, I want you to be able to verify it yourself. You found a channel that respects your intelligence. We watch the COMEX with me for a while. Reports daily. You know how we operate. These reports show how much silver is in registered versus eligible categories. Registered means available for delivery. So everyone can follow eligible along. Means it's stored at COMEX, is the primary futures exchange for silver in the registered number is what matters. When people trade paper silver, they're mostly trading COMEX futures contracts by delivery month. Each contract represents tells us how many contracts are still outstanding as we approach delivery. At the end of a contract period. If open interest stays high and demand physical delivery of that silver, that's a sign more people might stand in reality. Most contracts are settled in cash. Monitor the delivery. Traders roll their positions when a contract holder officially demands delivery. They file a notice. People actually stand for delivery. See how many notices are filed each day during the delivery period. Because there was always enough physical silver in COMEX warehouses to cover the small percentage. We watch the spread between spot price and futures price. Here's what's changed. When futures trade at a significant premium to spot, it can indicate look at the current open interest. When futures trade below spot, still open, it can indicate oversupply it to the registered silver inventory in COMEX warehouses. We compare COMEX data to global inventory specifics. COMEX, the latest data, only silver warehouse in the world. 30,000 we look at London, Shanghai, and other vaults to get a complete picture of global supply. Ounces. This is the process. Not speculation, not rumors. Could theoretically be demanded. Data tracking over time. Now, how much registered silver? Now I know some of you are thinking, John, warehouses they've always managed to avoid a real squeeze. Approximately, they'll just change the rules again. They'll raise margins. I need to share something with you that most people in silver is rigged. And I understand that skepticism. And honestly, even some experienced traders silver ran toward $50 in 2011. COMEX just raised margin requirements. When I say blinked, I mean something happened in the data that signals a serious problem. Do something similar again at the surface. But here's what's different now. That could trigger a squeeze. The physical market is tighter than it was in 2011. Off guard. Industrial demand is structurally higher. And global supply chains are more fragile. Of silver changing the rules can delay a squeeze to deliver. Can eliminate a physical shortage. I'm going to break down what that means for anyone holding silver. Every time they change the rules to protect a position system, this reinforces the narrative that physical contract data is more valuable than warehouse inventory. This and that narrative drives more people toward the physical. Which makes before I explain the data over time. Let me remind you what this channel is about. Again, they might change the rules. We don't do conspiracy theories without evidence. They erode. We track real data from real sources. At some point, trust matters more than rules. Warehouse inventories, commitment. Now let me be clear about risk because delivery. I know this sounds exciting. Something unusual shows up in data. Dangerous in markets. We break it down in plain English. For my USA audience, nothing in this video is financial advice. I'm not telling you to buy silver futures. I'm not telling you to take delivery. Welcome. I'm providing educational channel that respects your publicly available data. If you've been with me for a while, second, you know how timing is uncertain. Let's look at what squeeze could happen in February. So it could be delayed. What's happening? It could unfold slowly over months. Basics. So early and being wrong feel the same in the COMEX is the primary futures exchange. If you're trading futures, understand that margin requirements can change overnight. Paper silver positions. They're mostly trading COMEX futures contracts. Each contract represents 5,000 physical or different. And owning a futures contract is not the same as owning physical silver. The holder can demand if you're worried about delivery failures. Consider what form of silver you actually hold. Contracts are settled in cash. Understand the risk. Traders roll their positions to the next month. So here's what we're watching in February. Very few people actually registered inventory levels. If they keep declining, the squeeze probability increases. There was always enough physical silver in open interest as we enter the delivery window. Small percentage high open interest plus low inventory equals pressure. Changed. Number 3, February delivery month is approaching. A spike in early notices. When we look at the current open traders are serious. Number of contracts still open. Number 4, compare it to the registered silver inventory margin hikes or position limits could signal the numbers don't add worried. Let me give you
Number
the
5,
specifics.
price
As of
action
the latest
in physical
data,
markets.
there are approximately
Premiums on
30,000
coins,
contracts
bars,
still
and
open for
rounds
this
tell us
delivery
what's
delivery
happening in
period.
the real world.
Each contract
I'll be
is
updating you as
5,000
these data
ounces.
points evolve.
That's 100.
If this breakdown helped you understand what's happening at COMEX,
theoretically
please
be
subscribe.
demanded for delivery.
Not for my growth.
Now,
for your
how
awareness.
much registered silver is
When
actually
the February
sitting in
delivery
COMEX
period heats up,
warehouses available?
you want to be
for
getting real
delivery?
data analysis.
Approximately
Not hype,
30 million
not
ounces.
conspiracy, not
Hey
noise.
everyone, I need to share
This is
something
where that
with
happens.
you that most people
Turn
in
on
silver are
notifications.
completely missing
Drop a
right
comment
now.
below saying,
and honestly,
watching
even
COMEX
some
or
experienced
tracking the
traders aren't
squeeze.
connecting the dots.
It helps
on
the
this
algorithm
one.
find the right
COMEX
audience.
just blinked,
And it tells me
when I
you're
say
paying
blinked,
attention.
I mean something
Here's my
happened
promise.
in the data that
I'm gonna keep
signals a
tracking the
serious
data.
problem
I'm gonna
brewing.
keep
beneath
showing you the
surface.
math.
A
I'm
problem
going
that
to
could
keep
trigger a
explaining it in
squeeze in
plain
February
English.
that catches the entire market
COMEX
off guard.
just blinked.
I'm going to show you
The numbers don't lie.
I'm
Whether
going to
that
explain why
translates into a
87%
February
of
squeeze
silver
or a slow
contracts
grind
are
higher over months,
mathematically
we'll
unable
see.
to deliver physical
But being
metal.
aware of the setup
is
is
going to
better
break
than
down
being
what that
blindsided
means
by
for
the
anyone
outcome.
holding silver.
Silver holders,
thinking about
you know
entering
what's
a
happening
position.
now. You know what to
This
watch.
isn't
Stay sharp.
speculation.
Stay patient.
This is contract data.
See you in the next
This is
update.
warehouse inventory.